Now, why are we using this? Again, it goes back to the concept that this is just not enough, not precise enough for using just one type of application. Because production line nowadays is more complicated. Some portion requires manual work, some portion requires, and most likely a lot of the portion nowadays is automated. So we have different types of machines. Machine hours is incurred. When you separate a part that requires labor, separate the parts that require machine, setup costs, maybe a mixture. We have utilities involved as well to help prepare the manufacturing side for producing the products. Okay, so let's take a look at this example here. Again, DVDs, two types of products. We have Excel, we have specialized ones. If you just look at the last line, profit, what do you think this table is telling us? If you just look at the last line, profit. So the sales price per DVD is $12 each for Excel, $70 each for specialty DVD per disc. And the cost incurred for direct materials is $2.40 for Excel, $4 direct labor costs. Manufacturing overhead, the cost is $1.60. Add these costs together, subtract it from sales, it tells us that per disc you're able to gain profit $4, right? What about the right-hand side? $20 per DVD. So it seems like this profit is a lot higher than Excel, right? Because this is the base, we're capturing the base of per DVD's cost and its profit. But much of this information, yes.
The material price is still the same.
Material price is still the same, direct labor is different, manufacturing overhead is a lot different, right? But let's say intuitively this company looks at this report and just thinks that this is less likely the case. Let's say they think specialized DVDs actually factors in more labor cost and more manufacturing overhead. It should be more times over Excel DVDs. And intuitively, we think this profit number is just not, this profit is just way too high than what they've expected, assuming this. So now they recalculate this manufacturing overhead. So based on this information here, we know that we're only assigning manufacturing overhead based on direct labor cost here, right? This is an example from last chapter. So we just used direct labor cost to assign the manufacturing overhead cost. And now we use ABC, activity-based costing. We're trying to understand better what's actually factoring in the production line. So we separate activities, just specifically manufacturing overhead cost, into three types, as we talked about earlier. We have setup cost, burning stage, and at the end, case assembly. So if we take a look at these, we're trying to understand better manufacturing overhead costs, separate them into three activities, and we already found the three drivers here. Let's say Excel DVD, since it's a more popular, regular produced product, there's 100,000 requests from customer orders. For specialty, there's only 500 requests from customers. Okay, but if you take a look at this now, setup cost for the 100,000 DVD sets, what is the setup cost per DVD here? This is the total cost for Excel and for specialties. We want to know what is the unit cost. What would that be? Remember, we told you that now we have $100,000 Excel DVDs. This is our goal. We want to produce this. So how much will be the unit cost per setup?
45 cents.
Will be 45 cents. You just use 45,000 divided by 100,000, right? What about burning cost?
10 cents.
This amount, right? 0.05 cents per DVDs. We're just using all these amounts and divided by 100,000 here. Okay, because now we want to compare the unit costs between these two different products. Now the case assembly costs $10,000, and then you divide it by 100,000 will give us 10 cents, right? Okay, so this is the setup cost, this is the burning cost, this is case assembly. So take a look at specialty ones. Remember specialty, we only have 500 orders here. setup cost, 15,000 divided by 500, $3, right? What about the next one? DVD burning, 1,500. Sorry, this would be 30 for setup cost, right? And for 1,500 divided by 500, that would be $3. What about the last one? Last one, if we divide 350 by 500, gives us 70 cents here. Okay, so the unit cost here for each of these, if we add them together, 60 cents for Excel. What about unit cost for specialty ones?
33.70.
33 cents, $70. So is this the same as what we covered earlier? What was the cost for the beginning ones? If we use last chapter's method, the traditional method instead of ABC, we will be getting $8 cost per DVD for Excel, right? And the other one is $50, right? Are you following this? And what we're trying to do is, if we separate the cost of manufacturing overhead into more details, we're able to trace in more detail what is specifically machine hours used for this type of product, what is the setup cost used for different types of products, and what is the DVD burning cost used for different types of products. So the detailed breakdown actually leads us to understanding that manufacturing overhead cost here is 60 cents per Excel DVD, whereas in the beginning it was $1.60 on top. And here, specialty DVD really costs us $33 in manufacturing overhead, and if we match it to the beginning table, we have $13.60 on top. Meaning that earlier, if we just used direct labor costs to capture these manufacturing overhead costs, it would be inappropriate because we haven't captured anything related to machines, DVD burnings. So this number here relieves the more appropriate manufacturing overhead costs compared to the traditional methods. Okay, I know it's a little confusing right now. I see from your face.